I'm pleased to have with us Ed Duggar, founding partner and president of Reinventure Capital. Reinventure Capital focuses on high potential overlooked founders, those historically excluded by traditional investors, including Black, Indigenous, people of color, and women. Ed, welcome. Thank you so much for joining us.
Well, I'm delighted to be here. Looking forward to our conversation.
And let's start with your backstory about how you established yourself as a capital allocator.
Well, it's an interesting story because I never intended to be a capital allocator. My dream was to be an urban planner. I got my master's degree that way, and it was only by chance that I became a pioneer in this space. And as a result of a friend saying, "There's this venture fund in Boston that I think you'd be really interested in. You need to check it out." I did, and to my amazement, I was selected to be a junior member of the team. And that began but I was given the opportunity while I was there because this fund was focused on founders of color and shifting the flow of capital to funds or to companies that they ran. Um, I was given an extraordinary opportunity to make a difference, to have a real purpose that in my life that has now lasted for over 30 years.
Looking back over your career, what was the biggest revelation or aha moment that you had?
Over my career, and I started this pretty early in my career. I was 27 when I became head of the venture fund. And my aha moment, I think, came when I was actually hired for that position. I did not have a background in finance. I did not have a background that looked anything like venture capital. I received my master's degree from Princeton in urban planning and public affairs. So my aha moment came when I was actually recruited from positions that had to do with real estate development into a venture fund that was unique and had dedicated itself to participating in this shifting of capital. And, as I was being recruited, I thought there was absolutely no chance for me to be hired. A friend of mine had actually suggested that I apply. I was living in Indiana at the time. The firm was in Boston. And the aha moment was when they offered me a job, and it became apparent to me that the founder of the firm, who was white, a PhD graduate from Harvard Business School, looked through my resume to see something different in me that said that I could be successful at this firm. And began my understanding of the importance of value being created through circuitous paths to success. Most of our founders have had a circuitous route. They didn't start with the pedigree. They didn't start with the idea on a napkin or whatever. They worked for 10, sometimes 15 years in a particular industry or sector, positioning themselves to be founders and entrepreneurs at a more advantageous point in life. But most venture funds, if they see that circuitous path, going this, that, they don't give it value. They treat it as if it is, particularly with founders of color, that it is an indication of a lack of direction, a lack of focus, this, and this. On the other hand, we see it as, having overcome obstacles. And by overcoming obstacles, creating the kind of character, persistence, value, if you will, that would lend themselves to being successful founders. So going back to the original point, that experience sort of taught me to look beyond the resume because so often the resume does not say, this is a slam dunk, if you will, in terms of backing the founders, et cetera. And that served me very well. Many of the not only the founders we have backed, but also my team has circuitous backgrounds that don't suggest on the face of it that they will be very successful, except that when you throw in the value added by this circuitous background, it makes a huge difference.
Talk a little bit about how the Camel model specifically plays to the strengths of founders who have historically been forced to do more with less.
Well, let me frame it by talking about what the sort of popular ideal, and that's unicorns, where we have one, maybe two out of 10 generate extraordinary returns, and the for the most part, the rest of the portfolio is not supported, withers, or whatever. There are a lot of disadvantages of pursuing that approach for founders, primarily because the sort of thesis is that the way you become a unicorn is to grow very rapidly, and you grow very rapidly by spending a lot of money to buy into markets, create beachheads in markets, and you lose a lot of money. So in order to stay in business, you don't earn the money, you don't generate profits, you actually keep raising money. That may work for very, very, very few, but what it means for others is that you're constantly reducing your equity interest in the company. You're constantly shifting governance in your company. In other words, as more investors come in, they want a role on the board, they may want certain rights in terms of whatever. And if their investment is large enough, then they have a controlling interest. And you're in a very challenging position of sort of maintaining any semblance of control. So when that approach doesn't work, which it doesn't work most of the time, it means that founders end up with a minor, very minor position in their own companies. And it begins to feel more like a well-paid job as opposed to, creating something, whether it's the economic engine or whether it's something more spectacular than that. Okay. The Camel approach is one where it emphasizes profitability. So, and
Imagine that, Ed. Profitability.
yeah, you make some money, right? You pay your bills. Profit is your ticket to the future. That's the way I encourage our founders to think about it. It's not just making money for investors; it's making sure you have a future. So the model there, there's a certain amount of tension in the industry because you've got this one group saying, "Hey, this is the way you do it," and another group saying, this may take a little longer, but you'll be around. One of our most exciting portfolio companies is a company called OpConnect, which is an EV charging platform. And it's not focused on charging units at the home or whatever. It's for fleets, buses, trucks, etc. And so it comes with a platform that is very intelligent, AI driven, that allows fleet managers to decide which vehicle should be charged first, second, depending on the trip they're taking the next day, the weather the next day, or whatever. But the founder there, who is African American, aeronautical engineer, 15 years in Boeing's and the likes, before he went out and pursued his own interests. And he's been at it for 10 years. I call him, or I think of him and the company as going to be our 10-year overnight success.
Exactly.
He's done 3 or 4 different pivots before we invested. He's got it down pat now in terms of the approach that should be taken. And he is the only profitable EV charging company in the industry in the U.S.
Wow.
And he's growing very nicely, et cetera, et cetera. But if you look at when he got started and didn't believe in circuitous paths, which means doing a couple of pivots along the way, then you would have counted him out. Okay. And so we bake in our investing the opportunity or the expectation that there will be some pivots, 1 or 2 pivots before they kind of get it right. So what we're really betting on is not just the the merits of the venture itself, but we're betting that the founders will get it right soon.
I was chasing unicorns and this notion of growing at all costs to achieve that status. How is that at odds with building, or I'll say, is it at odds with building a truly inclusive entrepreneurial ecosystem?
It is, and I think the primary reason is that most VCs would be traditional, would be reluctant to believe that they could bet on a founder of color that could become a unicorn, that they would not have the capability to sort of even grow quickly if a lot of money was thrown at them. And so you really do. And what would happen, more likely than not, if they did, they would be looking at the company as the opportunity. They'd be betting on the company and not the people. So there would be a tendency to want to change those people and put in their people to make it work. So, I mean, that's one of the, which is a way of saying, even if you thought you had the opportunity to become a unicorn, um, the road to that is, and your being in control is hazardous. Just put it that way. Because one of the things that one of our portfolio companies, one of our stars, if you will, it had, when we made our investment, it was valued at about 10 million. 15 minutes later, it did its Series A at 120 million, and it raised 20 million in the process. It had gone from 2.5 million in revenues to 27 million in revenues in that year between. A Sandhill VC wanted to come in to that Series A, and they said to the founder, who was a woman, that we can do the whole 20 million, but here's the terms. You have to agree that you will not sell the company or do anything to sort of prevent the company from becoming a unicorn company, which means that, essentially we will have control of the company. We'll work with you to get to a unicorn status. The implication is we'll provide the money to fund that process. And it sounded on the face of it exciting to have a, Sandhill VC, as a key investor. This founder said no, because she understood that she would be facing the possibility of loss of control if she wanted to exit when the company was worth 500 million rather than $1 billion. She would not be able to do it. And so the whole idea about what is success comes back, For her, extraordinary success at 500 million versus $1 billion, and maybe no success at $1 billion, actually, valuation. So, she was able to raise the money, no problem, and continues to do very well. But I would just want to share that as an example of the issues that founders have to face, even when they have what we thought was an extraordinary company prospect for growth.
Well, I want to ask: is that a decision, a very conscious decision that a founder needs to make in terms of its strategy for the company's strategy for growth and all the time that it takes in order to fundraise, and the inordinate amount of time you spend fundraising versus on the profitability of the company? So, is that actually a decision that a founder should be making?
Well, Let me frame it just a little differently there because there's a way to think about it that way. Many founders, my experience has been that they have the friends and family financing, they have a seed financing. There's a pre-seed, friends and family, seed, which is, we're getting close, and then there's a post-seed, which is we've got revenues, we have a beachhead, we've got real customers, we have a strong management team that you can bet on. And then the next stage is thought of as a Series A, where funds for scaling up or in subsequent series. There's a tendency to want to go from post seed, the seed round, to the Series A. That often requires an extraordinary amount of time and effort and resources and diverting attention from the business itself on the part of the founder team. The way we've approached that is and encouraged our founders to think about it is not that leap. In other words, where the camel part comes in, let's have interim financings as well. In other words, rather than trying to raise $10 million or whatever for that Series A, let's do a bridge financing. Let's raise $4 million as a way to bridge you to the next. So you're in a better position to go to market for a Series A, that you've worked out more of the kinks, et cetera, et cetera. And that works very well. And in many cases, what we've been able to do by taking that approach with our founders and encouraging them to do the same is that we've allowed them to not take what are awful term sheets to do the Series A. Okay.
And there are many, many, many out there. It
Yeah.
happens so often.
Right. So we provide that sort of bridge or that more time. When we think about it, we're going to provide you with capital, and usually in the form of a convertible note or whatever, that allows you to better position yourself for a strong Series A as opposed to a weak one that'll take 9 months to get done if you get it done at all. So Camel reference, smaller humps or financings as opposed to one big hump. Exactly.
Now, you mentioned your founders not necessarily having the pedigree, and I want to acknowledge that you are a fellow Harvard alum. What kind of access did that offer that you think has helped to open doors for you?
Well, it's interesting. Since I have a sort of a dual Ivy League degrees, Harvard then
Exactly.
Princeton, uh, I think that what that's done at a minimum, perhaps, is means that when I walk into a room, it's assumed that I should at least be in the room, not necessarily at the table, but definitely in the room, because and that's I have had the privilege, if you will, to be in a lot of rooms where not only was I, a Harvard graduate or Princeton graduate, et cetera, but where there is a lot of need for confidentiality, a need for trust, et cetera. And so the trust building is a whole different part of the equation here. So the degrees get me in the room. Uh, these other characteristics that they're looking for, sort of get me at the table. Um, but I've also had experiences where, I've walked into a room and the assumption, not knowing my background, the 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 assumptions were very different. That's a way of saying that it'll take you so far, but to get you further, that you have to work at it. You have to have a network, if you will. I always thought it was very interesting that my background with finance, et cetera, venture capital, landed me on the board of the Federal Reserve Bank of Boston for almost a decade. and allowed me to, sort of understand how the economy really works. Because literally we met twice a month to determine what the discount rate was going to be, or at least our recommendation to the Board of Governors in Washington, et cetera. So all of those kinds of exposures, though, sort of allowed me to be trusted and to continue to enter rooms that others weren't able to enter. And part of the reason I mention this is because access is the real key. How do you gain access to be a part of networks that allow you to be influential and, not only to help have others work with you to shift capital in our case?
I love that. I think, it's the being in the room and seeing how things really work. There's how we think that they work from being on the outside, and then there's understanding how it really works when you're on the inside. And I think too, having in a sense, I know for me personally, there's a duality there, right? Where I've been in some of the rooms, you've been in a lot of rooms, where there's the trust and the kind of the inner sanctum, but then also understanding the experiences and having lived experiences that many of the people who are in those rooms do not have, and a level of understanding about why there are people on the outside who cannot get in, and who have not been allowed in. So, I think it allows for a different framing of not only what the problem is, but the path to potential solutions.
Yeah, one of the things that I've discovered as well is that many of the powerful leaders, particularly corporate leaders, who we tend to think about as not necessarily friendly to all the things we are interested in, are often not that way. In other words, that they have just the gatekeepers have prevented them from being exposed to things. And so I'll give you an example. I think this is relevant to what you do. After my last fund was harvested, I created something called the Business Collaborative. And the Business Collaborative was a business community initiative to expand the business that our largest corporations in the Boston area did with businesses of color in their own backyard. The motivation for that was the fact that I had spent my life to that point providing capital to an elite group of founders of color. And I really wanted to do more in terms of working with companies that were those economic engines I mentioned that would never get venture capital, but could be successful businesses. Okay. And so the Business Collaboratives was focused on business development with large corporations. We had about 20 that signed up, and we had about 35 to 40 businesses of color that we wanted to create this market for. But to make that happen, one of the other members of the board of the Federal Reserve Bank of Boston was Marsh Carter, who was the CEO of State Street Corporation. And we became friendly as we served together on that board. So when it came time for me to pursue this idea around the Business Collaborative, I went to him and said, "Look, Marsh, this is what I need to do, but I need a corporate sponsor from your world to do this. Can we do this together?" And to my surprise, he instantly said, "Absolutely." If I had had to go through a gatekeeper, that would not have happened that way. He fully embraced it and co-chaired this effort with me for several years.
Why were you surprised?
I was surprised because the impression that Marsh gave to the rest of the world was that he was a tough guy, that he had been a former Marine, he had fought in Vietnam. And if you were to read some of the things, he later became chair of the New York Stock Exchange, and you would think that he was conservative by nature. What I learned from him, though, was that, and one of the reasons it was so quick for him to say yes, is that one of his brothers, if you will, that he fought with in Vietnam was Black. So he had a life, and he continued to support this individual in other business activities, etc. So he was not new to this idea of sort of understanding what the challenges were, and on his own initiative, not as State Street, but as Marsh Carter helped support the person. And as we worked with these 20 corporations, we found much the same thing. I would go, for instance, to when I had the idea, I started by meeting with various CEOs one-on-one and saying, look, what are you guys doing with founders of color, businesses, Black businesses in your own backyard? And the consistent response was, I don't have a clue, but what do you have in mind? And that opened up a whole possibility, because suddenly, and the way we approached it was in terms of creating those opportunities, we didn't go to the procurement person. We said we only want to talk to the C-suite. And the way we're going to do this is we're going to sit down with you. We're not going to tell you how to do this or what you should do or pound on the table, whatever. We're going to stimulate your thinking about where in your company that you know so well these opportunities can be created. And invariably, they came up with 2 or 3, 4 ideas that were great ideas. And we took them back, repackaged them into business opportunities, presented them back to them and said, this is what we heard you say as a business opportunity. Can we run with it? And they said yes, because it was their own idea. So we created tens of millions of dollars of new business for founders of colors in the Boston area through the Business Collaborative, which is, if you look at my development, perhaps as a professional in this space, you've got the experience of venture capital, you have the experience of business development, and we are combining all of that in Reinventure.
I absolutely love that story because it really communicates a lot of our narrative about relationships and the importance of relationships and the ability and power of relationships to change mindset and to inspire people to act. And again, you said you were surprised because this person gave off this sort of public persona, and maybe actions that this person had taken. However, it was due to personal relationships that he had a different lens when it came to how they might be able to help and support and to open a door. Those know, like, trust relationships cannot be underestimated. For us, that's really the key driver. If you could make a policy recommendation to our government leaders to consider, what would it be?
My recommendation would be for them to dust off some of the history of what they've already done. Interesting, many of the catalysts, if you will, for successes in my earlier portfolios were a result of government policy. Just as an example, we built a broadcasting company, a TV broadcasting company called Granite Broadcasting. And the founder, African American, who was at Goldman Sachs, he was a senior person in their M&A area. He decided to leave Goldman and start a TV company. He was able to do it, one, because he knew the business from his own M&A experience, but also because the government had, through its internal revenue sort of tax policy, had created a program that allowed those who sold their companies, their TV stations, to Black-controlled companies specifically, could defer their taxes on their capital gains. And if they use the deferred taxes to buy in an industry, in the same industry, the broadcast industry, they could delay it even further. So that allowed the founder we backed to say, I offer you X amount of money for your TV station that you've owned for 30 years. I can offer you the same price as my peer over here, but it's a better deal because you get the tax savings on huge potential capital gains. Okay. That was specific to encourage the development of ownership in that industry by folks of color, our own government. I could point to other examples of those incentives, either through the tax policy or whatever, which were created to have that happen. Government policy just by, sort of dusting off what had been done before.
What insights would you share for investors in our audience who are seeking the best returns?
I think that it would be sort of reiterating what we have found that's useful in terms of a lens in our own investing, and that is value the circuitous route of founders. One, look beyond the resume. In other words, look to what I value a lot of obstacles. How have they overcome obstacles? How have they been knocked down and put themselves back up? How have they been tested by facing failure and somehow overcoming the odds? Because all those are characteristics of a founder of resilience, perseverance, determination, commitment, etc. At the end of the day are going to define the person in terms of these years you're going to spend with them to create a success on their part. Align values, I think, is very important. And by align values, one of the important things we've talked about today is sort of impact. Using money for more than just a return. Be on the same page there. I think all those things will result in a happy experience one way or another with the investor, because you knew the risks, you took the risk, you gave someone an opportunity. More times than not, they'll make the best of it and create a success that everyone will be happy about.
For our allies, for people who consider themselves to be allies, who say that they want to see greater inclusion within this entrepreneurial ecosystem, what advice would you give them?
Yeah, I would say do homework. As an example, in our current Fund One, Reinventure, I was knocked off my feet really, because after the killing of George Floyd, we had people come to our website who wanted to invest because they had decided in the wake of that they wanted to better align their money with their values. And they put it exactly that way. So we had investors from various walks of life that invested in our fund because of that. And I think that, hopefully, in the coming days, there'll be opportunities for investors to sort of rally around the issues of any number of them that speak to the importance of being engaged with your money, aligning it the way that makes the most sense, particularly if you have it to invest.
Ed, thank you so much. This conversation has been super insightful, and we really, really thank you for making the time to join us today.
I enjoyed it. And best of luck in your endeavors. You're doing important work.
Thank you.